Alright, so welcome to Value Investing Final. We're going to go through your review. Feel free to print this out, fast forward, rewind, do whatever you need to do. We're going to just go through this one quickly. If you get all this information, you should be fine for your final. Right? Okay, number one, who is known as being the founder of value investing? That's Benjamin Graham. Benjamin Graham. He was kind of the one that wrote quite a few books around this area. He was the one that Warren Buffett ended up picking up quite a few of his principles from reading his material. All right, number two, define valuation. This is a very basic definition. Doesn't mean this is how you determine valuation. This is just the definition of valuation. It is determining a company's value or worth. Determining a company's value or worth. Number three, describe in your own words the two main approaches for determining the value of the company. So basically, I'm wanting something along these lines. One of the approaches tries to project out how much cash the company will make across the term of its life, or say for the next 15 years or something. And so it makes projections forward about how much money the company will make and determines its value that way. The other approach is to look at a snapshot of the company currently and see how much money and assets they have currently and let that be the value of the company. Right? Okay. Number four, what is the danger of forecasting methods that rely on assumptions? So this is kind of that method that we're talking about where they make projections forward. The danger there is that you don't know really how much money this company is going to make over the next 10 or 15 years. Industries could change, leadership could change, technology could change, competition could change. So the method of trying to project out forward how much cash a company will make over the next 15 years is really just, it's too much of a guess and not an actual real concrete valuation. Number five, describe in your own words the three main rules given in class for an investor. All right. So let me go through these just real quick. There were three of them. One of them is that the market often produces extremes and variableness in its pricing that is not reflective of the actual value. So the first one, if you just put the market often produces extremes in its prices, right? So that's kind of the first one. If we went through these three rules of an investor, the first one is that understanding the market often goes through extreme highs and lows let me clear this out. That the market often goes to extreme highs and lows in its pricing. The second one is that the underlying value of the stock is not necessarily reflected in those extremes of the prices, right? So the price in A, the price of the stock could go very high, could go very low. Principle B is that the underlying value of the stock does not change with as much frequency as the price does, right? So if the price is super high one day and super low the next, the company itself didn't change that much during that time. It still had the same facilities, same employees, for the most part, right? And then C is that good investing is looking for opportunities where the price has gone below the underlying value. So we know the price sometimes goes too high and sometimes goes too low. So what you're looking for are those moments when it goes too low, and those are opportunities to buy. Okay. Number six, what percentage of professional money managers do not beat the S&P 500's average return rate of 12% a year? So the S&P 500, that's 500 stocks that kind of give an estimate of the economy, so to speak, and so a lot of people use those as benchmarks because the average rate of return for the S&P 500 has been about 12%. And so if you just took an index which is one an equal share in all 500 of these companies, and you invested in an index fund that does that. An index fund is a fund that invests in a set number of stocks equally. And so the S&P 500, there's several index funds where that's all they do is they take all the money that comes in and they invest it equally across the board in everything that's in the S&P 500. Well, the average rate of return over the years for that has been 12%. And so that becomes a benchmark that if you're putting your money in some other mutual fund and it doesn't average 12%, then you would have been better off just putting it in the S&P 500. And so the average, it is actually 70% of professional money managers do not beat the S&P 500. Now, let me just go a little further in that, just to, an extra little bit of food for thought. That's in any given year. 70% of money managers do not beat the S&P 500's average return. But when you look at it out over years, the numbers are even worse as far as money managers being able to beat, so for a money manager to be able to do more than 12% over 10 or 15 years, it goes even lower than that. So, maybe 80% of money managers do not beat 12% over 5 years, and then probably 90% of money managers do not beat 12% over 15 years. And so that means then that you have a very low chance. If 90% of all these other mutual funds are not going to average more than 12% over the course of 15 years, then you have a very small chance of picking, the 10% that do. Which the idea there is that for the average investor, it's much better to just invest in one of these index funds. All right, number 7, list and describe the 3 main types of variables that can be used for evaluating a company. All right, so the first one there are fundamental variables, and that's the main one. So fundamental variables refer only to a company's performance. It doesn't include anything with stock price, just simply their performance. This was return on capital, growth in sales, profit margin, these types of things. They're fundamental variables that only refer to the company's performance. Momentum variables, that's B, momentum variables are variables that focus only on the change in stock price. So this is stuff that you get a lot with people. When you look at somebody's, like the charts that these day traders use and people that invest in the stock market, they're always looking at some kind of chart with all these lines and variables and stuff on it. Those are often momentum variables, and they are only affected by the change in stock price, right? So we didn't get into that too much in class discussion because we weren't really interested in that, but that is the second class of variable. And then the third are what are known as price to fundamental ratios. And so the idea is you're taking the first 2 categories and making a ratio out of them. So you have fundamental variables are things that only look at what the company's doing in its brick and mortar business. How much sales does it have? How much cash did it earn? You have momentum variables that are only looking at its stock price. What happened with the company's stock price? Then you have price to fundamental ratios would be something like this. Stock price to cash earned. Something like that. What was the ratio of stock price to your earnings? And those are price to fundamental ratios. So that's the third category, price to fundamental ratios. Those compare the current stock price with some fundamental variable from your first category there. So that first category was fundamental variables. This last category compares the current stock price with one of those fundamental variables. So I'll give you those 3 again. Fundamental variables, that's stuff that only deals with company performance. Momentum variables only deal with stock price. And then price to fundamental ratios take the current share price and compare that with some fundamental variable from your first list there, right? Okay. Number 8, describe in your own words the significance of monitoring return on capital. So this is what I want you to do on your own. We did the entire lesson there on return on capital. And so I'd like you to go back in and look at that and have some good thoughts there for the importance of return on capital and why you need to know that for your company. Number 9, list and describe in your own words each of the 4 quadrants in the market share discussion. All right, so I'll touch on these just briefly. You may have to go back in there and look at that discussion. But we had one that is in a high growth industry with high market share, and those are your shooting star companies, right? So they're in a high growth industry and their market share is high. Those are your star companies, right? Then you have high growth industry and low market share. So they're in a really good industry, but they're not doing all that well. And so these are the ones where there's a lot of questions surrounding the company. Why are they not doing well? Then you've got a low growth industry and high market share. So this means that the industry itself is pretty stable. It's not growing, it's not booming, but they have a big share of that stable market, and those are really good cash producers. And then the last one, it's a low growth industry and they have low market share. That's just a bad company. So there's not much potential there, right? So the industry itself is not booming, and they don't have much of a market share in this industry that's not growing. They're in a bad position, that 4th group. Number 10, list the 3 aspects of valuation, right? So what I'm looking for here: asset valuation, earnings power valuation, and profitable growth valuation. Number 11, which financial document is the most essential for asset valuation? That's your balance sheet. All right, your balance sheet is the one that goes through item by item the different assets that a company has. Number 12, explain how you arrive at a net asset figure. So basically what you're doing to get a net asset figure is you're taking all of your assets, adding them up, and then subtracting from that all of your liabilities. And then what's left over are net assets. Okay. Number 13, in what way does the current state of a company's industry affect its asset valuation? Well, basically what I'm after here is if the industry is dying, then a lot of the things that company has don't have as much value. Their machinery, their production lines, things like that, their inventory. Think of the VHS company. Because the industry is dying, who wants a machine that makes VHSs? The value of that is going down. Or who wants all their leftover VHS tapes if nobody's buying them anymore, right? So if the industry itself is dying, then their assets can't be valued very high anymore, like what they might have purchased them for. There was a time when each VHS might have cost $5. But now, you're not going to sell a whole shipment of VHS tapes for $5 each. Because nobody wants them. All right. Number 14. What aspect of an asset valuation is always valued at book value? That's cash. All right. Whatever cash they have, it doesn't matter their industry. When you're looking at their balance sheet, the cash is it's always valued at whatever it is, right? So you don't have to change anything with the cash part of the balance sheet. Number 15, explain in your own words why growth in sales is not necessarily a sign of a healthy company. All right. So the idea is that when sales grow, and I'm only going to give you just a hint because this is one of the ones I want you to go back in and look at the lesson that we did on this. But the idea is that when sales grow, so do other expenses that go along with that, right? And so that's kind of the hint for that one. And so so you want to go back in and look at that lesson. Number 16, when valuing assets, why would you discount some items on the balance sheet? Well, the reason that you would discount some is that, going back to that same example with the VHS, maybe the inventory, even if it's not a dying industry, say if you're buying a company and you've got all of this inventory, you've got 10,000 of whatever it is that this company is going to sell, chances are they're not going to sell all of them. In order to value their inventory at 100% of its value, they would have to sell every single one of them, right? And so a lot of times companies don't sell all of their inventory. And so when you're giving a value of their inventory, you don't want to give it at 100%. because then the only way to ever get that is to sell everything, and most of the time companies don't do that. So you would look at inventory and maybe give it 85% of its value, knowing that they're probably not going to sell every last thing that they have, right? Or another one is assets receivable, or accounts receivable rather. That's the people that owe them still for things, right? So they've given them the product already, and these people have promised to pay. But I mean, not everybody pays. That's why there's bill collectors and stuff like that. I mean, people lose jobs, people don't make payments, whatever happens. And so, you very rarely get 100% of your accounts receivable in either. So if somebody's looking at that and they're trying to evaluate the company and they've got $1 million still to come in assets receivable, chances are they may only get 900,000 of that million back in, because there's going to be some people that just don't make their payments. And so that's why you would discount some of the things on the balance sheet when you're trying to value a company. Number 17, what is the difference between reproduction costs and liquidation costs? So reproduction cost is what you would pay if you were buying it new right now. Like if you had to buy a machine new right now, how much would it cost you to do it? Liquidation cost is if you just sold one to get rid of it quickly, what price could you get for it, right? The way that you would look at that is reproduction costs are often higher. So it's in an industry that's booming and still growing. If they're going to buy new machines, they have to buy them at top dollar value, because nobody's giving them at a discount because they're still worth a lot. Liquidation is when the industry is dying and you're just trying to get rid of the machines you have, but nobody hardly wants them, and so normally liquidation costs are much lower. What you would get back in a liquidation is much lower than what you would pay if you're buying at reproduction costs. Okay. All right. So that's the final. Make sure you go back into those 2 or 3 that I've given you to do on your own. Review those lessons, and you should be just fine.